You only need to master 2 out of 3 chart patterns if you want to be profitable. And in this video, I'm going to be showing you 3 chart patterns smart money don't want you to know. Now, this strategy is based off of market manipulation, and no, this is not a smart money concept strategy. What I mean is it has nothing to do with the label smart money concept. I'm going to be showing you how market makers or smart money create certain patterns in the market to trick retail traders to go in the wrong direction and end up taking your money. For those new to the channel, my name is Dan Fix, and I teach people how to trade in line with market makers and market manipulation for free on this YouTube channel. So make sure you subscribe to the channel to get more of my videos on your homepage. Forex chart patterns. I'm going to be showing you the 3 chart patterns. I'm going to be revealing them one by one. All right, so the first one is wedge formations. All right, the first one is wedge formations. I'm going to be showing you how market makers use wedge formations to take out liquidity to trick retail traders to go in the wrong direction. So after wedge formation, I'm going to be going over the second one, then the third one, and I'm going to be showing you guys with examples for each of them. So first of all, wedge formations. How exactly do market makers use wedge formations to take out liquidity? So now we all know basic market structure that we've learned on the internet for free, right? We all know that an uptrend consists of higher highs and higher lows, right? Higher highs and higher lows, and the downtrend consists of lower highs and lower lows, right? So what exactly is a wedge formation? We know consolidation is equal highs and equal lows. So a wedge formation is basically like an anomaly where you have a high, you have a low, and you're having lower highs, and you're also having lower lows. So you're having lower highs, you're also having higher lows. So when you have lower highs and higher lows, it begins to form a wedge pattern in here, right? So price begins to squeeze and squeeze to a point to form a triangle where you can actually draw a line like this, draw a line like this, and then you know that at the tip of this wedge formation, you're going to have a breakout either to the upside or to the downside, right? This is how wedge formations work. You have a high, you have a low, then you have a lower high, you have a higher low, you have a lower high, so you have a higher low like that. It's not an uptrend, and at the same time, it's not a downtrend. It's basically consolidation, right? But a different type of consolidation where it consolidates and squeezes to the tip where it now breaks out. All right, so when you have an uptrend, for example, and price has been going up, follow the trend is your friend, right? Market has been going up. What happens when you have higher highs and higher lows, and then all of a sudden you begin to have lower highs and higher lows at the same time, right? You begin to have this, and then price begins to form a wedge formation like this. What happens in the mind of retail traders when this happens, right? So what people will do is they will draw their wedge formation, right? You can call this a bullish flag or pendant, or I don't know the exact words they call it, but I just call it a wedge formation. So when you have an uptrend, price has been going to the upside, and then all of a sudden you have a wedge formation like this. What usually happens is people expect price to break to the upside to continue the uptrend, right? And when price breaks to the upside, you're gonna have a lot of people. When the price breaks to the upside, you're gonna have a lot of people buying these breakouts, expecting price to continue higher, right? So now what usually happens is when market makers form this consolidation, what they're doing is accumulating orders inside this consolidation zone, and also creating a pattern to make people take this trade to the upside. Now, market makers are ready to reverse this trend. They're ready to take this back down. But in order for them to take it back down, they need to induce buyers into the market so that they can sell against the buyers. And that's why they'll create this pattern to get you to buy the breakout. So when people begin to buy this breakout like this, what's going to happen is price is going to come to this high, to the highest point of the wedge formation. Sometimes it might not get to the highest points, and then when it gets there, it's going to reverse like this. So a lot of people are going to be trapped in here taking buys, right? And the market makers are going to reverse against them. The same thing goes for when you have a downtrend and price begins to form the wedge formation like this. Then people begin to draw their wedge trend lines. And then moment price breaks to the downside, people are going to be selling this. What's going to happen is price is going to reverse back up, right? So let me just show you guys a couple of examples of this so you can have better clarity on what I'm talking about. So here's an example of a wedge formation that happened on EURUSD on the 1 hour chart. Now, we have this uptrend, right? You can see this uptrend. Then what happens? After the uptrend, price begins to form, price from the high, from the low, and then started forming lower highs and higher lows, and then it's squeezed all the way to this point here where you expect price to break out, right? So at this tip, everyone is expecting price to break out and are anticipating to take the buys. Now, what happens when price breaks out of this area? People begin to buy all the way in here, taking the breakout. I remember I told you that they will break out to the highs and then reverse off of that high. So now you can see that after people started taking buys, now it took about 1, 2, 3, 4 candles to get to the highs. That is, each candle is 1 hour. So that is, it took 4 hours for price to get to these highs. And guess what? It took 1 hour for price to completely wipe off this entire move. So it took 4 hours to go up and took 1 hour to come back down, right? And when price comes back down, you can see that price completely melts from that area, leaving everyone that took buys in here stuck in drawdown, or this is going to blow your account if you don't put your stop loss, right? So either hit your stop loss or you blow your account, right? So let me go to the next example. Let me not waste too much time. We have another example here. Now, this example is on a 5-minute time frame. Let me grab my pen. 5-minute time frame. You can see it up here. So we have this uptrend. Price is going to the upside. All of a sudden, price forms a wedge formation. Sets the high, sets the low, and begins to chop in here. Squeezes to the tip. Price breaks to the upside, getting people to take buys in here. Price reverses back down, and you can see price completely melts from that area. So if you're trading these patterns, you're going to be selling. You're going to be selling at the tip here. You're going to be selling somewhere in here. So as people are taking buys, they're going to be selling. All right. The next example here, we have a wedge pattern. You can see the highs and the lows. Price begins to consolidate to the tip, breaks out of that tip with 1 candle, reverses it with the next 2 candles. These are 15-minute charts, by the way. So this took 30 minutes to go back up. And completely from that area, price completely leaves that area. Now, anyone that took sales in here is trapped. The moment this candle appears, this blue candle appears, price takes off, and anyone that took sales in here is stuck in drawdown. All right. Now, this is going to be the last example for this wedge formation where you have an uptrend, right? Price is an uptrend, sets the low, sets the high, begins to consolidate to the tip. Here, you can see how price just squeezes to this tip, and then price breaks to the upside, getting people to take buys, take buys, take buys. This was a news candle. All right, so before the news, prior to the news, market makers were inducing buys, inducing buys. Now, they took how many candles to go up? They took a bunch of candles to go up, and they used 1 candle to completely shift out of that area. All right, so everyone that took buys in here, all right, you can see they came to the highs. Anyone that took buys in here is going to be stuck in drawdown the moment this candle shifts, and then you can see that they continue going down from that point. All right, so let's move on to the charts. Let's see. Yeah. So now the second chart pattern I'm going to be showing you is M and W formations, right? M and W formations. Now, each of these formations are actually connected to each other. They're just different variations of this M and W formation. So the wedge formation is just a variation of an M and W formation. And the last one here, I'm going to reveal at the end, is also going to be a variation of this M and W formations. So M and W formations, how do they form? It's kind of almost the same concept with the wedge formations, but it's quite different. This is where you have maybe an uptrend. price is going to the upside. Now, these patterns are reversal patterns. They're used to reverse the market. They can also be used to continue as trend continuations, but that is a different topic for a different video. So this one, we're talking about reversal patterns. All right, so price is in an uptrend. What's going to happen is price is setting highs and lows, higher highs and higher lows. That's an uptrend, right? So what's going to happen is price is going to pull away. If market makers want to reverse this trend, price is going to pull away and begin to consolidate. Once price pulls away and begins to consolidate, right, they're going to attempt to go back to this high. When they attempt to go back to this high, people are going to be anticipating price to continue up, which is not going to happen. Price is going to just come to this area and reverse off of that area. So a lot of people are going to be taking buys in here. That's where you can draw your wedge formation in here. All right. Sometimes it might give you a wedge formation. Sometimes it might not give you a wedge formation. So an M formation can also be a wedge formation like this. All right. Sometimes it's not, sometimes it is. So it's actually the same concept with the wedge formation. So you have an uptrend, then price pulls away, begins to consolidate, right? Goes back up. A lot of people are going to be buying this, expecting price to continue up, higher highs, higher lows, like that. Price is going to set the high, come to this high, reversal of that high, and then eventually drop. That's how you have your M formation, double tops and double bottoms. So let me show you a couple of examples. So here we have an example of an M formation that formed back to back. So we have, let me grab my pen. We have this M formation here, and we have this M formation here. All right. So what do we see happen? We see that price was making its move to the upside, all right? And then all of a sudden it pulls back and then begins to consolidate in here, right? And you can see price attempts to go back to that high, to this high, fails to break the high, reverses off that high, and then you can see price completely sells off. Now, people are going to be taking buys in here, expecting this to continue up. So they expect something like this, right? But what's going to happen is this. So they're expecting this, but this is going to happen, right? Same thing appeared. The same thing happened here. We have this low, we have this high, we have this low, we have this higher low, we have this higher high, we have this higher low, we have this higher high, we have this higher low. What do you expect? You expect a higher high. So a lot of people are going to be buying in here, expecting price to continue up. Price hits the high, fails to break the high, comes back down, and then you can see that price completely melts down after that. So here we have another example of the M formation where you have the low, we have a high, higher low, higher low, higher high, higher low. We have a higher high here. We have a higher low. You can see price attempts to form a higher high. A lot of people are going to be expecting this to continue up. Price comes back down, gives you this M formation like this, and then you can see price drops all the way down from there. So here's another example. It's going to be the last example for the M formation. So we have this uptrend here. Price forms the low, sets the high, comes back to this high. A lot of people are going to be expecting this to continue back up. Price hits the high, fails to break the high, and then reverses from that area, completely melts back down. All right. So let's move on to the charts. Let me reveal the last one. So let's go over here. Now, the last chart pattern you're going to be looking for is head and shoulders patterns. Now, this one is the same variation. It's just a variation of an M and W formation. Now, the wedge formation is a variation of an M and W. The head and shoulders is also a variation of a M and W formation. So the way the head and shoulders pattern work is the same way the M and W formations work. Just that this one is where you have a liquidity hunt. So you have a uptrend like this, and then price sets the high and then comes back down and begins to consolidate. Now, in this example, what's going to happen is price is going to go to this high, but price is going to break the high. So when price breaks the high, it's going to signal to a lot of people that this is a trend continuation. This is forming higher highs. Then what's going to happen is price is going to come back in down like this. So this is going to be your liquidity hunt, stop hunts, right? So what's going to happen is price is now going to attempt to go back to that high, but not break this original high and not reach the original high. Just come close to it, and then price is going to reverse from there. Usually these two sometimes are on the same level. That's the two shoulders sometimes are on the same level. Sometimes they are not. Just different variations on the theme. So price is going to go back up here as a pullback, right? And then gonna come back down to reverse the trend. Now, the same thing works for a downtrend. When you have a downtrend, you're gonna have the liquidity hunts like this. Then price is gonna go up, and then price is gonna come back and then continue back up. That's your head and shoulders pattern, inverted head and shoulders pattern. So we have the normal head and shoulders pattern, and then we have the inverted head and shoulders pattern. Now, the reason why this is a variation of an M or W formation is if we just simply take out this part of the pattern, this left shoulder of the pattern, you're gonna see that this is just simply an M formation like this. All right, and if we take out this part of the pattern, you can see that this is also an M formation. All right. So let me show you guys a couple of examples of this on the charts. So here's an example of the head and shoulders pattern. Here we have the 15-minute charts. So you can see price from this uptrend, from this high, from this low. You can see price breaks the high, right? Breaks the high forms. So this is the left shoulder. Then price forms the head, and then price comes back down, pulls back to this area again, and forms the second shoulder, and then price reverses from there, taking this back down. Here's another example. Here we have price forms this shoulder, goes back up. You can see that price comes for a liquidity hunt. This is the stop hunt to take out liquidity below this level, right? Takes out the liquidity, goes back up. You can see price comes back here, close to this level, but not exactly equal to the level. So comes back, and you can see price reverses from that area. You're going to be taken by here or here. This is your shoulder, head, shoulders pattern. So here's another example. This is actually a trade that I took this week. So here we have the shoulders. We have the liquidity hunt, which gave us the head of the shoulder. You can see price goes to the upside, comes back down to this to form the second shoulder, which is not exactly equal to the first shoulder, right? But it's still a head and shoulders pattern. So if you clear this out, this is going to give you like a W formation. If you clear this out, this is your W formation here, right? So I actually took this trade here. I put my stop loss below and cut this, closed somewhere up there this week. If you guys want a more in-depth breakdown of how to trade these patterns, I'm going to be launching a free course. Click the top link in the description of this video to sign up so you can be the first to know when it launches. Peace.